Okay, Marie says it's time to start, so let's go ahead and start. Good morning, everybody. Just a couple of announcements this morning. Don't forget that tomorrow I'm offering a math chat. Kelly's the one that's actually named those, but I was thinking about it because I mentioned this on Tuesday, but one of the, to make no mistake about it, one of my largest sources of job satisfaction is talking to you guys a little bit, getting to know you guys a little bit, and just basically getting to know you and have you getting to know me. With 1,000 students, like I said, like I've been saying from the beginning, it's really next to impossible to do that with everybody. But trying to do what I can to facilitate that. So kind of in that spirit, tomorrow, today's Thursday, right? Tomorrow, I will be out at Reflection Pond at about 4 o'clock or so. I think Zhao's going to come and hang out with me in case nobody shows up. That way I'm not out there by myself. But we're going to be out there from about 4 till about 5 or so because the Young Investors Club has a special meeting tomorrow night at 5:30, I believe it is. So we're going to be out here anyhow. So I'm just offering the opportunity if you guys want to come by and say hi, you get extra credit for it. So make sure you print your form and bring it, all right, like I talked about yesterday. But really, we can come talk about whatever you want. I mean, if you want to talk about something about class, that's fine. If you want to talk about something else, that's fine too. So it's really just, all I'm trying to do is create an opportunity for me to meet more of you, okay? That's all it is, all right? So like I said, I'll be out at Reflection Pond somewhere out there. I hope there's no other events going on out there because with my luck, I'd schedule it during Spirit Splash and everybody in the world would be out there. But that's already passed. So I'll be out there, like I say, about 4 o'clock. Cut me a little slack if I'm running a couple minutes late, but should be there about 4 o'clock or so. And just come on out if you like. And like I said, it's an extra credit opportunity for you. So got that. I announced this on Tuesday. Be reminded, extra credit is due. It's like a couple of days before Thanksgiving. You remember the 24th? Yeah, because Thanksgiving is 26th. 24th. So your extra credit, the form is due to them. That means they have to be in physical possession of your form by the 24th. Okay? So, yeah. Yeah, I talked about that on Tuesday for like the 6th time. So, yeah. And they've been getting emails about it, and I've seen a couple discussion postings about it, despite the fact that I've said it. That's on the video Tuesday. Video's closed up Thursday of next week, so you got plenty of time to review that. That's an issue I'm done talking about, but yes. Okay, so I think that wraps up extra credit. And Chapter 9 homework, the first half will be released today. So I think you have a week to do that, if I remember correctly. And then the second half I tentatively have scheduled to release after Tuesday's class, assuming we'll get through statement of cash flows by then. So we'll see. But the first one will be released today because I'd be shocked if we didn't finish up the income statement today. Okay? And I think that's anything else that I'm forgetting. I think that's it. Questions? Other questions? Other questions? Oh, I know what I was going to say. One other thing about the extra credit, you should be doing this anyhow, but just for the record, because I walked in this morning and someone had slid an extra credit form under my door, okay, which it's really supposed to go to the TAs, but I'm not going to split that hair with you, whatever. But much more importantly, you should be doing this anyways. I don't know why you wouldn't do this. When you turn in your extra credit, give them a day or 2 days to post it, but you should see it pop up on Canvas like pretty darn quickly after you turn it in. If it doesn't, you need to contact them. Okay, don't wait until Christmas. And you've got a 79 in the course, and you say, oh, well, I should have an 80 because I did the extra credit, but it's not on there. Okay? Don't wait till then because then it's too late, all right? You should be doing that anyhow, but just for the record, if you turn it in, and we're keeping meticulous records about this, so just for the record, we're keeping meticulous record on this stuff. But if it's not on there, then you need to contact them and say, hey, I turned it in, why isn't it posted? Okay, and what they're going to do is they're going to look through all their forms and they're going to say the reason it's posted is because we don't have a form for you. Okay, so, all right, questions? Questions? Okay, all right, then let's go ahead and continue with the income statement. Actually, before we do, anybody watch the debate last night? Okay, anybody catch, in a different context, But for a few minutes there, I started to record it and bring it in here and play it, but there was too much politics and not enough business in that, so I decided that that might not be a wise thing to do. But an issue that we talked about in class on Tuesday actually popped up in the debate last night. It was in a different context, but it was, at the end of the day, kind of the same issue. Anybody catch it from the few of you that watched the debate? Anybody? So when they were talking about yeah. Well, yeah, they talked about the corporate tax, and we've been talking. Well, yeah, okay, that is fair, because we have talked about the flat tax. Okay, and, all right, yeah, so there were two issues, okay? And you're actually right about that because they're talking about the flat tax. And what you'll notice on that is most of it, and by the way, just for the record, this is not a political conversation, this is a business conversation. But taxes have a political component to it because it's one of the vehicles that politicians use to try and get elected, okay? And if you listen to it, most of what they were talking about was the tax rate. Okay, well, as you'll see when we get to the end of this course, the tax rate isn't the problem. The problem is figuring out what's taxable and what's deductible. That's the problem, okay? So there was that, but no, there was another issue. Yeah.
Yeah. They talked about
Social Security tax, yeah. Medicare, yeah. We had talked about that, but there was something Tuesday that we were talking about.
Didn't they talk about
Talk about what?
carried interest?
Yeah, they were talking about interest in there. Okay. Now, what they were talking about the pharmaceutical companies. And they were talking about all the pharmaceutical companies consolidating and getting to the point to where there's no competition and getting into anti-competitive legal issues with that. Okay, and we were talking about that in a slightly different context on Tuesday when I was talking about being a cost leader and selling things below cost for the purpose of driving out your competition, for the purpose of monopoly, which can potentially be, I think it's called antitrust issues. Okay, and like I say, I started to video that little segment there and bring it in and play it today, but there was too much politics in there, so I didn't want to do that. But so in a different context, but what we were talking about, and all of these other issues as well, particularly the flat tax. I'll get wound up on that at the end of the course. So, all right. So that was there's your briefing from the debate last night. So, all right, we're starting talking about the income statement last week, and really just going straight down the income statement. You should now be familiar with the slang term top line, which is the revenue, the sales on the income statement. We talked about some revenue recognition, some potential revenue recognition issues there, and the issues revolve around really two topics with respect to companies recognizing their revenue. Those are measurement and timing. Measurement and timing. Okay? So we talked about that. We talked about cost of goods sold a little bit because we had talked about that quite a bit back in the inventory section. So sales minus cost of goods sold got us down to gross profit. All right, the gross profit ratio that they refer to in the book is more commonly referred to as gross margin. Very good. So we got down to that. We started talking about operating expenses a little bit last time. We talked about this here. Some typical or operating expenses are typically classified into three categories. Noticing the first one, wake up marketers, noticing the first one is selling expenses. Okay, now think about that. Those are selling expenses to sell the product, of course. Shouldn't they be in cost of goods sold? Why not? Outstanding. Outstanding. Yeah, these are not in cost of goods sold because the costs that are in cost of goods sold are the costs that attach to the product. Okay, so these costs are not a cost of producing the product. All right, so this would be your marketing costs, sales commissions. Hope you can see that. Okay. Sales commissions, advertising. Costs like that, okay? Those are not costs of producing the product, they're costs of selling the product, okay? Now, this is according to GAAP and IFRS, All right, you marketers out there, in an effort to sell your marketing plan or accomplish whatever it is you're trying to accomplish, you might argue something different to a company. Don't ask me what that argument would be, okay? But if you understand the financial statements beyond the prior courses, then you might be able to make an argument that, hey, even though GAAP says that my costs should be accounted for this way, really they should be accounted for. The economic substance is they're really this other way, which would benefit you because. Okay? I'm not a marketer, so don't ask me to fill in all those blanks, all right? But that might be something useful in your toolbox. Okay, so we got selling expenses, okay, got all that. General administrative expenses, which are pretty self-explanatory. That's kind of your miscellaneous category. And then research and development, R&D costs. Okay, how are R&D costs accounted for on the income statement? Let's say you incur R&D costs in your company to develop whatever it is you're working on. You incur, let's say, $50,000 of R&D costs this year for this product that you're working on. It's not completed yet, but you're working on it. How's that accounted for? Yeah.
They're expensed in the period they incurred.
Outstanding. They're expensed immediately. Expensed in the period in which they're incurred. Okay. Now, that used to be different way back in the day. They used to be capitalized and amortized. Okay. But what the standard setters have recently said since then is, well, because of the uncertainty, okay, remember final exam review, remember our definition of an asset. Okay. An asset is something that's expected to pay an economic benefit in the future. Okay. But it's got to be measurable. Okay. So what they're arguing is that because these costs are so uncertain, then they don't know whether they're going to pay an economic benefit. Therefore, they're not an asset. Therefore, they shouldn't be capitalized. Okay, there's your line of logic. Okay? So you expense it instead. All right. Now, what you might argue is, as an analyst, as a decision maker, companies are required to do this. Okay. Well, you might, in your valuation of the company, say, yeah, but that's not right. Because with this particular product, there is going to be a payoff. So in your analysis, when you're calculating your ratios and all that kind of stuff, then you may choose to modify the financial statements that you've been given and calculate your ratios slightly differently. If you're right, then you beat the rest of us. If you're not, then you don't. Yeah.
Well, here's my question for you. Now, when it comes to research and development, Apple knows that they're going to sell millions of the new iPhone every time they come out with it. So would they expense it immediately, or could they capitalize it because they know they're going to sell it?
If it's R&D, then it should be expensed immediately. If it's a product that's already been developed and they're just tweaking that product, then that would be capitalized in the product. So it kind of be depend on. I think it would depend on the nature of the cost. He's asking whether or not Apple should capitalize R&D for iPhones.
From the 6 to the 6S, isn't that, or just about the new iPhone in general?
Well, when they go from the 6 to the 6S, I mean, that's a pretty detailed question. Off the top of my head, I would say that's not research and development. That is design modification or whatever you want to call it. So that would be my initial impression. But what this does illustrate is an example of the gray area in GAAP. Okay, because an exam question, all right, so the issue is they're developing so they've already come out with a 6S, so let's say now they're working on the iPhone 7, okay, they're incurring these costs of the iPhone 7. The question at hand is, should they be accounted for as R&D costs, or should they be capitalized as product costs? If Apple's earnings were lacking this period, then what would their incentive be? To capitalize it. Very good. To capitalize it, because that would reduce their expenses. They'd have to depreciate, or I guess it'd be part of inventory, so they'd have that, but it would reduce their expenses and therefore help their earnings out. Okay? If they were having an exception, if they were beating expectations on their earnings this year, then their incentive would be the opposite. Now, that was an issue about not what they should do, it was about what their incentive is to do. Specifically, I really think it would boil down to the nature of these costs that they incurred. Okay, I mean, if they were developing a new antenna for the iPhone 7, then I would be more inclined to say that that's an R&D cost. If they're improving the memory, then I'd be more inclined to say that's a product cost. Okay. All right. So R&D is expensed immediately. All right. Oh, I changed it on here, not on there. So this is where we are. So multiple step income statement. Again, I mentioned this on Tuesday. Single step is used by pretty much nobody except very simple businesses, and you're not here to solve simple problems, so multiple step is what you want to do. So we've talked about everything, and we are right down to this point right here, which is income from operations, operating income, a very, very important calculation. Very important calculation, because notice that below here, you've got interest, you've got gains, and so forth and so on. Everything below operating income is considered either a financing cost or a one-time occurrence, something that's not going to recur into the future. Okay? So income from operations is an important calculation because it captures the core operations. Right? So let's see, what else was I going to say about that? Financing. Oh, and just be reminded what's not on here is you would also have preferred dividends down here. If they had them, of course. If they had them. Okay, so just a reminder on that, but okay, let's say that you're looking at two companies, A and B. Right? You look at their net income. A finally getting the hang of this board. I told you it would happen by Christmas. Okay, let's say A has net income. It has a net loss of $1 million, and B has net income of $2 million. Okay. Which company is the better investment? You tell me. Her question is, do we need more information? And my response is, you tell me. Okay, I agree with that. On the surface, it looks like B. Okay, but if you go beyond that, let's say you start looking at the income statement. Suppose you find operating income for A is $8 million. Operating income for B, that's supposed to be $3 million, not 0.3. I don't know how that is. When I sit up here shooting my mouth off about how good I'm getting the board, I don't know how that happened, but I'll take it. I'd rather be lucky than good. Yeah. Okay. So, and then B has operating income of 3. So what that means is, of course, let's see, it'd be 1, and this would be what, 9? So if you look at it a little more closely, what you might find is A actually has a higher operating income, but the reason they have a net loss is because either they have too much in financing costs, which is a relatively easy problem to fix, or maybe they have some sort of one-time, they sold something at a loss. Okay? So in terms of their core operations are actually more profitable than B, yeah. If they bought a new building, who, A? Yeah. If they bought a new building, why would that drive their net loss down, or their net income down?
Not sure. I was asking, well, you said if they sold something at a net loss.
Yeah.
If they
maybe they sold a building, particularly with the real estate market. Maybe they sold.
Would that also, bring their, 'cause that's.
Well, you tell me. If they bought a building, would that help to explain that help to explain this?
They may have bought it without financing.
Okay. All right. So on one hand, if they bought it and they financed it, okay, yeah, that might help explain it. If they didn't finance it, then that wouldn't. Okay. So I didn't think about that. So that's a good point. Yeah.
I mean, you could just tell a company A cannot control the expenses as well. If you can't control the expenses,
Well, I would agree that Company A probably isn't controlling their expenses as well, using your words, but which expenses? And that's really what I'm getting at here, is because the point of this is what operating income is capturing the operations of the business. So apparently they're controlling their operating expenses pretty well. What they're not controlling very well is either their financing expenses or these one-time, again, maybe they sold something at a loss. Maybe they did buy a building and their financing terms on the building stink. All right, which is a lot easier problem, in my opinion, a lot easier problem to solve than to solve the problem where you're running at an operating loss before we even start talking about the financing of everything. Okay, yeah.
So, for the next period, would they be able to carry back the net loss? Or
Well, yeah, let me defer that conversation until we get to the tax part. But the short answer is, yeah, for tax purposes, they'd be able to carry that loss forward. But let me defer that till we get to the very end of the course, because we'll talk about that quite a bit then. Yep.
I was going to say that company probably has another possibility to have a lawsuit that they lost. So they lost a lot of money on that.
There's a good thought. He's saying that Company A might actually have a lawsuit going on, and lawsuits are generally accounted for, final exam review, as, where would you see them pop up on the financial statements? Very good, a contingent liability. Contingent liability. Well, if it gets to the point to where it's likely to happen and reasonably estimable, then it will be taken out of liability and put into there. So yeah, and there's probably lots of other possibilities as well. But again, the point here is that these are, operating income is capturing the operations of the business. So the argument is that in this limited, simple example, A looks like it's more valuable than B, okay? But then we could even go further, okay? Now let's take a look at gross profit, okay? This is assuming sales are relatively the same, so forth and so on, okay? So there's lots of possibilities here. But again, my point is going beyond the obvious. Anybody can look at earnings per share, okay? Well, her earnings per share are higher than his earnings per share, therefore she's doing better. Not necessarily. I shouldn't say doing better, therefore her company's a better investment. Not necessarily. If it was that easy, we'd all be making money in the markets. Yeah, I'm listening to you.
Even if their operating incomes were the same, and A's net income still has $1 million loss, it could still mean that, they are still growing,
I agree. Yep, I agree. Even if what he said was their operating income was the same, but A still had a lower net income. Yeah, it could. And what we were just looking at here was just one period. Okay, so get in the spirit of that. Let's say we look at multiple periods. Okay, so we've got Company A, Company B, and let's say we're looking at a couple of years. 1, 2, 3. All right. So Company A, net income. Company B, net income. So let's say that Company A has net income of $1 million each and every year. Okay. Company B has a net loss, what do I have here? Net loss of $1 million, net income of $6 million, and then a net loss of $2 million. Okay. Well, again, which one's the better investment as a decision maker? Why you say A? Okay. With just this information, I wouldn't disagree. In fact, I would agree that A is probably a better investment because the earnings are more stable. Okay? They're more, and if you'll notice, across the 3 years, earnings is the same, okay? But they're more stable in 3, suggesting a less volatile business, and therefore, possibly a better investment. But you dig down into it deeper, all right? And let's say you find operating income for A of $4 million, $8 million, $2 million. Operating income B, $5 million, $8 million, $6 million. Now, yeah. Yeah. Okay, why B? Okay. More potential for growth.
Company A has, I mean, their net income is, steady.
Right.
There's no growth.
There's no growth in A, okay.
It's held constant, which means that maybe the process or something else is.
Okay, he's saying there's more growth potential in A than in B. I'm sorry, you're saying more growth potential in B. Okay, in B than A, okay. Yeah.
I think with this, it depends on the person, like how risky you want to be.
Well.
I'm conservative, so I would choose A because they're still very like steady.
Okay. She would choose A because she thinks that A is less risky than B.
Yeah, to piggyback off what she's saying, company B is very volatile. So looking at company A, you kind of know exactly what you're going to kind of get what's in here.
Yeah. Well, company B is more volatile relative to what? Or using what as a proxy? Net income. Yeah. But actually, company B's operating income is more stable than company A. And that's actually the issue that I'm trying to get across here, is that if you look at it, company B has very volatile net income, but their operating income is more stable. Company A is the opposite. Their net income is very stable, okay, but their operating income, which is a measure of their core operations, is more volatile. All right, so yeah.
But wouldn't then you argue that the management style of plan B would need a better look at compared to part A?
Whether the management style of B needs to be taken a look at, yeah, I would certainly agree with that. Because, again, and it's the same conversation we just had, there's something going on below operating income right here. Is it bad financing? Are they just getting hit with a lot of one-time issues? What's going on? And that may or may not be a management issue. But regardless, what you could argue is that because B's core operations are more stable, it's actually the less risky investment in the long run. Now, those who are all they're doing is listening to earnings reports, and all they're doing is paying attention to this, okay, that may be bouncing the stock price around a little bit. Okay, but if that's the case, then that presents an opportunity for us as decision makers. Because every time they bounce that stock price down, that's a buying opportunity for us. Okay, all year long, for reasons that are not relevant to this course, every time the stock market has dipped, I've bought. Because I think I've thought all year long that the market was going to close higher than it opened. So every time the stock market dipped, as of, I think it was yesterday, the stock market was back to break even on the year, and I'm up 4.12%. Okay, buying the dips. Okay, so the same argument might be made here. Okay, if all they're paying attention to is this, every time they dip, we buy. Okay, and we could go on and on. The point of this wasn't a concrete solution. The point was issue identification. Okay, and going beyond just looking at the earnings. And underlying, emphasizing the importance of the operating income calculation. That was the point. Okay? All right, so questions or other comments on this? Questions, comments? Okay, good. You'll see that again on the homework. All right, so that gets us down. I guess we'll go ahead and do this. They kind of put it in kind of reverse order because they talk about gains and all the stuff we were just talking about after this, but I guess we'll just go ahead and do this now so I don't forget. We'll get back to the gains and losses and the one-time stuff in a minute, but we were comparing operating income to net income, and really net income is usually expressed as earnings per share. Okay, we're in the middle of earnings seasons now. I was watching CNBC last night. They were talking about all this earnings stuff being released, and it's always expressed as earnings per share. Okay, what you've been doing in the homework so far when you've been dealing with earnings per share, of course, is calculated net income divided by, it's actually the average number of shares outstanding. What I have done so far purposely is on the homework, the number of shares outstanding have been constant. They haven't changed. Okay, In the real world, that's not very realistic, except for maybe small businesses. But for publicly traded companies, that's not very realistic. If for no other reason, then publicly traded companies usually have some sort of stock buyback program, some sort of stock repurchase program. And final exam review, I guess this is an exam review as well, when a company repurchases its own stock, that will be accounted for on the financial statements as outstanding. You guys are making me feel so good. Treasury stock. Treasury stock. Okay, so now let's take a look at earnings per share where the number of shares outstanding is not stable. Okay, and by the way, earnings per share is the only ratio, at least the only one I'm aware of, and I'm pretty sure it is the only ratio required to be disclosed on the financial statements. So all the current ratio, debt to equity ratio, all that kind of stuff, none of that is required. This is, okay, so you will see this on, on income statements. So what we've got here is a pretty good example, Cruisers Inc. I was just watching the movie Eddie and the Cruisers the other day. Anybody see that movie? Good movie, especially if you're a musician. Great soundtrack. Anyhow. All right, so September 1st, beginning of the fiscal year. What does fiscal year mean? Yeah, say again? Very good. So the fiscal year is the business year as opposed to the calendar year. Okay? Calendar year goes from January 1st to December 31st. Business year is whatever their business year is. It's usually assumed to be the calendar year, but not always. Yeah. Yeah, companies do get to choose their fiscal year. They can't change it every year, but usually what they will do is they'll choose their fiscal year based on the operating cycle of their business. Okay, the classic example is like a ski resort up in the mountains. Okay, well, when is their busy time of the year? Yeah. November through March or something like that. So in the middle of that, December 31st, the last thing they want to be doing is this kind of stuff. Okay, they're making money. So they might choose a fiscal year of July 1st to June 30th, which number one gives them time to do it, but much more importantly, that actually captures an operating cycle because their cycle is going to go from season to season. So yeah, good question. Good question. Okay, so the Cruisers, did you have? Yeah, yeah.
So will companies who don't really know how their operating year would go, they know calendar year?
Yeah, when a company first incorporates, it's been so long since I've done it, I don't remember exactly. I guess they would probably be prompted to choose their fiscal year, but the default is always the calendar year.
Could they switch?
Yeah.
After they get a good idea of what they're
Oh yeah, they could switch subsequent. Yeah. In fact, when I was in public accounting, I wasn't involved in it, but we actually talked one of our clients into changing their fiscal year. So yeah, they can most definitely change after the fact. Mm-hmm.
So if they change their fiscal year, how will they measure like that whole period? Like if it's longer than 365
Yeah.
days or shorter than 365 days?
See, this is an example of, I give you my best guess as to how long it will take to go through things, but I really don't know. I had no idea we were going to spend this much time talking about the definition of fiscal year. Good questions. I mean, great. That's why we're here. But I had no idea we were going to talk this long about fiscal year. They would have a short year. So, which for tax purposes is a real headache, but that's a whole nother conversation. So if they're on the calendar year and then they decide, ski lodge or whatever, and they decide they want to change, then they would have a 6 months called a short year. And they would have a 6 month short year. Yeah. Now that we've had this discussion, I don't ever recall hearing of a publicly traded company changing their fiscal year. I would imagine they could if they had a good reason. I've never heard of that. I guess probably because by the time they get to going public, their business is so well established, they know darn well what their operating cycle is. I mean, that would be my guess, but that'd be something interesting to look up. I don't know. Because whenever I've done it, it's always been with non-publicly traded companies. Okay. Anything else about fiscal year? I think this is the longest I've ever talked about fiscal year in a class. That's good. I mean that is, I'm saying it jokingly, but that's a compliment to you guys. Okay, good. All right, so let's see. So September 1st is the beginning of their fiscal year. They had 200,000 shares outstanding, and I want to make sure we got the facts straight here so we can do the calculations. On December 3rd, they issued an additional 40,000 shares. On June 28th, they bought back 15,000 shares. Okay, so a couple of exam questions here. Number one, calculate their weighted average shares outstanding for the year. Number two, calculate their earnings per share for the year. Okay, so earnings per share, is pretty much easy now that you know how to calculate net income. So let's take a look at calculating the average shares, and I'm going to show you two ways because they show you one way, and I'm going to show you another way that's the same way, but I think it's a little more intuitive. So what they have here is the first part of the year. Okay, so for 3 months of the year, 200,000 shares were outstanding. Okay, so multiply that across. For the next 7 months of the year, 240,000 shares were outstanding. So they issued an additional 40,000 shares. That was for 7 months. The last 2 months of the year, only 225. That's interesting because I didn't touch the screen. Last 225 shares were outstanding. When you're doing this, make sure that your numbers add up to 12 months. Because if you don't, you did something wrong. Okay, that sounds like a no-brainer, which it kind of is. It's easy to make those mistakes, especially when you're in the heat of battle. It's easy to make those kinds of mistakes. Okay, so multiply that across, add it up, and you get 2.73 million. Divide that by 12, and what that gives you is 227,500 shares that were outstanding during the year on average. Okay, so that's a weighted average number of shares that were outstanding. Okay? Yeah.
How come this is not done quarterly?
How come what's not done quarterly?
Earnings per share, wouldn't you do it quarterly?
Wouldn't you do what quarterly?
Like, figure this out, like I noticed that here it's, different amounts of months, 7 months, 2 months.
Well, yeah, the question at hand is calculate the average number of shares outstanding for the year. So if you were doing it quarterly, then you'd do the same calculation, except it'd be quarterly. What's that?
Same thing.
Yeah, same thing. Yeah, the math's the same, yeah. Other questions? Other questions? Okay, you could do the exact same calculation differently. This is just math, okay? It's the same thing. But you could look at this another way. So let's see what we've got. We've got number of shares outstanding. Percentage of the year that it's outstanding, and then the weighted average, okay? So you could look at it this way. They had 200, and again, this is the same thing, it's just different math, that's all. All right. They had 200,000 shares outstanding for the first 3/12 of the year, okay, which is 50,000. Okay. Then they had 240,000 shares outstanding for the next 7/12 of the year, which is 140, and then only 225,000 outstanding for the last 2/12, which is 37,500, which gets you down to the same 227,500. So whichever way makes more sense to you, do it that way. It's the same thing. Yeah.
What are those letters like in the middle of the
This is percentage of the year outstanding in the middle right here. Yeah, I'm trying to save a little bit of time, but percentage of the year that it's outstanding. Yeah. Weighted average. Weighted average. Yeah. So number of shares outstanding, the percentage of the year that they're outstanding, and then the weighted average. Okay, so like I say, it's doing the exact same calculation, just slightly differently. Whichever one makes more sense to you and you can remember on the exam, do it that way. All right? Other questions? Other questions? Excuse me. Oh, I did insert a slide for that. Okay. All right, just a reminder, like I've been telling you, preferred dividends would actually come out of this calculation as well. They give you an interesting example here, and that is they give you preferred dividend requirement. Okay, so these are dividends that have not been paid yet. All right. So if the dividend, now these are for preferred dividends, all right, assuming they're cumulative, okay? Final exam review, what's that mean? Go, yeah.
That if you can't pay them this year, you accumulate that amount
Yeah.
that you owe them for the next
Exactly. If they're cumulative, if they're not paid for 1 year, they carry over into the future. So before anything else is paid, they've got to be paid, all right? So if they're cumulative and they haven't been paid yet, and if they have not been declared yet, okay? So I've got a company, you guys own preferred stock in the company, it's cumulative, so if I declare a dividend, then I have to pay you, the dividends, but I don't have to declare a dividend, okay? So if you have that stock and I have not declared a dividend, then in the notes, it's going to be reported as what's called in arrears. Okay, so the dividends will be in arrears. All right, so they haven't been declared yet, but if the company pays a dividend, these got to be paid first. Okay, if it's been declared, then of course you already know that that's going to be a current liability. Okay, so their point here, kind of a reminder on that, but their point here is that would be taken out of your net income calculation for the purpose of calculating earnings per share. Okay, which would get you down to this, and this is what's called basic earnings per share as opposed to diluted earnings per share. We'll get to that in just a second. Okay. So once we have that here, once we have those numbers figured out, here's our math that gets us down to $5.48 per share. All right. So we were comparing operating income and net income a couple of minutes ago. Usually you don't hear companies talk about their net income. What you hear them talk about is their earnings per share, which is this right here. Okay. Questions? Other questions? So far, so good? Okay. This is required disclosure on the financial statements. You'll see that in just a second. This is what's called basic earnings per share. Okay. More sophisticated companies can have instruments that they've issued that can be converted into shares at the investor's option. Poor wording, at the investor's discretion. Okay. For example, stock options. That's what I get for running my mouth earlier. Stock options. Okay, so I'm the company, I've issued stock. Okay, so let's say you're sitting out there and you don't own stock in the company, but you do own what are called stock options. What does that give you the right to do? Finance majors, pay attention. If you don't know this. Yeah.
It gives you the right to convert whatever it is that you have, whether it's into more common stock or whether it's a bond.
Well, a little tricky way of saying it, but a stock option, at least the basic call option, simply gives you the right, it's a contract, and it gives you the right to purchase stock at a particular price. Okay, you as investors. Okay, but yeah, the Young Investors Club loves stock options. Whole different conversation. Okay, but that's at a very, very basic level. That's what stock options are. Okay, so again, I'm the company. You guys don't own stock in the company, but you do own stock options. Okay, and those options are with me. So what that means is that at your discretion, you could purchase stock in my company, and I have to sell it to you. If you think about that, what that's going to do is it's going to increase the number of shares outstanding. Okay? Which is to say it's going to dilute the earnings per share calculation. because we still have the same net income, but if you exercise your right to buy more shares, the number of shares is going to increase. So we're going to take the same net income and spread it across more shares. So it's going to dilute the calculation. Does that make sense? Okay. So for that reason, they're called diluted earnings per share. All right. So what a company is required to do is really two disclosures. First is the basic earnings per share, which we just went through. And then the second is diluted earnings per share, which basically is telling the world if everybody exercised their right, and we don't know whether they're going to or not, but if they did, then our earnings per share would not be the 538 that we just calculated, it would be something lower. Okay, yeah.
How do you acquire stock options?
You buy them. Well, there's lots of ways to acquire stock options. Typically, you buy them. Sometimes employees, and in this example, probably the way it would work is that an employee is sometimes given stock options as compensation. That's part of their benefits package. So for the next 3 years, at your option, okay, I'm going to give you stock options as an employee in the company. If you want to buy the stock at an agreed upon price, then for the next 3 years you can do that. And if you do it, I got to issue you the stock. If you don't, I don't. So again, I don't know as the company, I don't know whether or not it's going to happen. All right. So the basic earnings per share and diluted earnings per share if you exercised your right. Yeah.
Typical company like I work for Publix, they give all employees stock options.
Yeah, Publix employees always pipe up when we get to conversations like this. Great company, but I wish I worked for Publix. Well, I love you, Dean Jarley. I love being here at UCF. Go ahead.
Do you assume that if under diluted earnings per share, if everyone were to buy the max amount of stock options, that's how we calculate it?
Yes.
Or a certain percentage, like assuming that you're never going to buy.
No, it's calculated as if everybody purchased the maximum that they could. Okay, and what we're doing here is just one example of stock options. Okay, and there are other ways to acquire it, which is really what he was getting at a minute ago. Convertible bonds. So, we've talked about really the plain vanilla bonds in here, but you could also purchase bonds in a company and it might have a convertible feature to it, meaning that for every bond that you purchase, you have the right to purchase, 5 shares of the company at such and such a price. Okay. Again, as the company, I don't know whether or not you're going to do that. Okay. But you have that right as a bondholder. Convertible preferred stock, which if I remember correctly, is what Warren Buffett bought when he bailed out Goldman Sachs. I told you that before, where he negotiated the terms of his preferred stock, and I believe one of the terms was he had the option to purchase to convert that preferred stock into common stock at whatever price. Okay, so all of those are, and there's probably other reasons that we could come up with if we thought about it longer. But again, the point is that there are instruments out there that would force the company to issue additional shares, but they don't know whether or not they're going to do it. Okay, so and just one final note, so you got basic earnings per share and then the diluted earnings per share. The diluted earnings per share will always be equal to or lower than the basic earnings per share. Okay. There could be situations where earnings per share actually increase. Don't ask me to give you one, but where earnings per share actually increased, and that would be considered anti-dilutive. And if that actually happened, then what they're required to report them equal. Okay, but for all practical purposes, probably in 99% of the cases, with the true calculation, the effect will be a dilutive effect. Therefore, diluted earnings per share will be lower than basic earnings per share. Okay. Questions or other questions about that while I catch up in my notes? Undeclared, I talked about that. Diluted, I talked about that. Oh, by the way, this rule right here, final exam review, is another example of the conservative principle. Okay, because on the financial statements, they're not going to report, anti-diluted earnings per share at higher than their earnings per share, because that would potentially make the company look better than it really is. Okay, so there's another application of your conservative principle from way back in chapter 1. Questions? I'm being sincere. Questions? Okay. All right, so that's our earnings per share required disclosure. I'm sure you have one or two homework problems on that. So kind of getting back to in between operating income and net income, there can be all sorts of things in here, one of which is extraordinary items. In fact, Kelly, who is on top of the recent rules on this, was just telling me the other day that extraordinary items, they're going to be doing what with it now? Do you remember? Okay, so right now they are reporting extraordinary items in a separate line item. Okay, yeah, in a separate line item, but apparently they're in the process of changing these rules to where they're actually going to report them in gains or losses. In either case, for our purposes as decision makers, it's going to be below operating income in either case. Okay, but you could have some unusual things in here, discontinued operations, which is exactly that. Extraordinary items, which is exactly that. And then non-controlling interest, which we talked about the other day. So they give you an extraordinary item example here of an earthquake. I think here in Florida, we could use a hurricane in there, and that would probably be a good example. Maybe lightning strike, something like that. Okay. Understand that that would come out of your net income calculation and therefore would be reflected in earnings per share. But again, these are non-recurring items. How often are you going to have an earthquake loss? How often are you going to have a hurricane take out a building? Okay, probably not very often. So again, as decision makers, if we just have our blinders on and all we're looking at is earnings per share, then we're going to miss this information, because the earnings per share may very well include something like this. Therefore, when you're making your decisions and you're taking the financial statements as prepared and modifying them to dig deeper into the underlying economic reality of what's really going on in that business, then instead of using the earnings per share as reported, you might take a look at them before this loss, which gets us back to the same conversation we had a little while ago. Okay, so yeah, their earnings are lower, but it's because of that, therefore, but their core operations are actually better than they first appear. Hopefully, nobody else is doing that, because if everybody else is just looking at earnings per share, then hopefully what they're doing is driving down the stock price, which gives us a buying opportunity. Was there? Okay, yeah.
Question for you. It says net tax benefit of $22,500.
Yes.
Is that included in the $52,500?
Yes, always pay attention to the word net. Always pay attention to the word net. So this earthquake loss 52.5 is net of the tax benefit of 22.5. The question is that 22.5 included in the 52.5? The answer is yes. Yes. Okay. Always pay attention to the word net. Yeah.
So why did they give the additional $30,000 for the $22,500 included in the $52,000? Where's the other $30,000?
Well, that was what they're saying, is that there was an earthquake loss, but they took that loss on their tax return and received a tax benefit from that. Okay, but the net loss is still 52.5. The net loss is still 52.5. Okay. All right. And also what you'll see below, so this is, we were just looking at this a minute ago. Also down here you'll have gains or losses. We talked about gains or losses before, final exam review. How do we calculate gains or losses? Gains and losses. Okay, and they're talking, let's see, they're talking about gain on sale of plant assets. Okay, so how would we calculate that? Yeah. No, you're thinking about, well, you're thinking about depreciation. Okay. Well, no, you're thinking right. You're not. You're saying it kind of, yeah.
Cost less than book value.
Costless, yes. What? Okay, we're getting closer. All right. Okay. Gains or losses. Okay. It's going to be the proceeds. Actually, the net proceeds, because you may have commissions or whatever in there. Okay. But basically, what you received for it minus what you paid for it, basically, which is the cost. But remember that the cost, you need to take out accumulated depreciation, which gets you down to book value, or the tax term for this is the basis in the company. So you've got the proceeds, what you paid for it, net of accumulated depreciation. And that will be your gain or loss. Okay. Same thing, they give you an example here of loss on sale of investments. Well, it's still the same basic calculation, what you received minus what you paid for it, except in the case of investments, you wouldn't have any accumulated depreciation. So it's if you bought a stock for $100 a share and you sold it for $120 a share, what's your gain or loss? $20 a share. Okay? So it's really that simple. Just remember that for depreciable assets, you have to account for depreciation in there. Okay? All right, that was a final exam review. Questions about that? Those little, everybody okay with that? Yeah.
Just to be completely sure, so when you subtract that cost, you're also subtracting the depreciation to that as well?
Yeah. Got a building. Okay. Yeah, that's fine. Building. You sold the building for $1 million. Okay. So sales proceeds, $1 million. Okay. You paid $700,000 for the building. Okay. So your cost is $700,000. Okay. But you've taken $100,000 of depreciation on the building. So accumulated depreciation is $100,000. So the book value of the building, as carried on the financial statements, would be $600,000. Therefore, the gain on the building would be $400,000. And in my example, just to correlate it, in my example a minute ago, I said, well, what if you bought a stock for 100 and you sold it for 120? Okay. Well, your proceeds were 120. Your cost was 100. You don't have any depreciation on investments. $20 per share gain. Okay, yeah.
Sorry, you lost me after you got to the book value. How did you get the
1 million minus 600,000 is 400,000. Okay. Other questions? This is a final exam review. I think this was on one of the prior exams. Final exam review. Questions? Okay. So that wraps up income statement, the first half of chapter, whatever chapter we're on, income statement. No, this is Home Depot's, there we go. Home Depot's annual report that I pulled up just as an example. Before I pull up the income statement, notice what we have on here. All of this, with the possible exception of statement of cash flow, should mean something to you now. Okay, balance sheet, statement of earnings, which is just another name for the income statement. All right, statement of comprehensive income. We talked about that. We've talked about that last couple sessions, but one of the things I told you last time was that the comprehensive income could either be reported in the statement of shareholders' equity or in its own statement. In this case, they're reporting it in its own statement. Okay, as opposed to statement of stockholders' equity, statement of cash flow, which is the second half of this chapter. The notes to the financial statements is which is where you got to go to find the details, as much as they disclose. I mean, we talked about full disclosure last time, or adequate disclosure, which is the principle last time. They're required to give you adequate disclosure. Okay, and then just a 5-year summary. Okay, so if we pull up the income statement Hopefully what we should see is everything that we have just been talking about, okay? So here you go. Net sales, so sales net of discounts, allowances, returns, okay? Cost of sales, just another name for cost of goods sold. Okay? Get you down to gross profit, operating expenses, okay? Selling and general, so what we saw a minute ago was selling and then G&A on two different lines. They just combined it on one line. Okay? Depreciation and amortization. So exam question, does this company own some intangible assets? Yes. That would be too easy of an exam question, but just to remind you. Gets us down to operating expenses, so our operating income. Okay. Then we have the other things that we were just talking about, interest, investment income, interest expense, other things, okay? Gets us down to earnings before provision for income taxes, and provision for income taxes is just another way of saying income tax expense, okay? The provision for income taxes, which we're going to talk about at the end of the course, okay? Gets us down to net earnings, which is just another name for net income, okay? And then weighted average common shares, which we just talked about how to calculate, get you down to basic earnings per share, diluted average, down to your diluted earnings per share, noticing that the diluted earnings per share are less than the basic earnings per share. So that would be a good test question in there somehow. I don't know exactly how I would word it off the top of my head, but diluted is always less than or equal to basic. Said another way, diluted earnings per share is never higher than earnings per share. And that's it. And by the way, notice they say, see accompanying notes to consolidated financial statements. What's the difference between financial statements and consolidated financial statements? We talked about this last time. Go ahead.
Non-controlled interest?
I'm sorry?
Non-controlled interest in other companies?
Oh, help us out.
When you have when you own more than 50% in another company.
Okay, exactly. When you own more than 50% in another company, then you control that company, therefore the two companies are really just one company, and you're required to consolidate the financial statements, which is to melt them together. Remember we talked last time about eliminating all the intercompany transactions, because you can boost your sales just by selling to yourself. All right, and therefore mask underlying economic reality. Yeah.
My question for you is, in the 203 yesterday, we were talking about Home Depot.
Yeah.
69% debt finance.
Yeah. Okay.
As a decision maker, wouldn't that kind of scare you away from investing in them, knowing that they're 69% debt finance? Yeah, they have a good.
If Home Depot has a lot of debt, yeah, that might scare you away, but I mean, and that would pop up in interest expense, which would drive a difference between operating income and net income.
As we were talking, yeah, they have enough, 13 times the revenue to pay the interest expense, but they keep growing the percentage
Yeah.
versus equity.
Well, let me defer the debt of Home Depot over to your 3403 class where you were talking about it, because what we're looking at here is the income statement, I mean that's a whole big issue. Yeah.
Just a general question, why Home Depot? I feel like that's always used in, examples.
Why am I using Home Depot as an example?
Yeah.
Because I felt like it. Other questions? Because I felt like it. Other questions?
I just wasn't sure if there was something special about the company.
No, it's one, it's in our stock averages, and the classic one used to be IBM. I got sick of using IBM myself, so I stopped using IBM. But coincidence, I pulled it. When I prepared the PowerPoints, I'd put it on there. And yeah, actually, one other reason for this, however, is because they actually have inventory. So I wanted to show inventory on there, but there's lots of companies that have inventory. Yeah.
So as like a decision maker, whether you're
I love the way you guys are starting to think. Yeah.
whether you're like buying into a company or kind of just if you're running it,
Mm-hmm.
seeing how to manage it, is there anything besides earnings per share and the operating income you're going to pay special attention to?
Oh my gosh, yes. His question is, are you going to look at other things besides earnings per share to make your decision about whether to invest in companies? And oh my gosh, yes. I mean, that's what analysts do. You know, I mean that sincerely. That's what they do. I mean, they were looking at Apple the other day. They're talking about they try and forecast the number of iPhones that are sold. You know, this new iPad Pro. How's that going to affect their top line? Oh my God! I mean, that's a whole career. That's a whole career, and that's why we're doing this, because this is the beginning. This is the beginning, and the reason this course came about is to help you start down that road of how to actually do that. Okay? But you can't do all of that stuff if you don't know what retained earnings means. You can't analyze financial statements. You can start projecting all this kind of stuff, but if you don't know what retained earnings means, good luck coming up with a good analysis. So, oh my gosh, yes, there's all sorts of, and it's particularly, if you're internal, I was talking about this in the other class, and I don't know if I mentioned it here or not, but one of my former students, brilliant girl, ended up working for a Fortune 500 company, and she asked me not to mention the name of the company, but she's working over in Dubai. So she was in the international area, and she was in the international part of the company, and she was in the cosmetic division of this big conglomerate. And every quarter, when the company's trying to forecast their sales, what she does is she forecasts the sales for her product for her little region, and then passes that along. Okay? Well, everybody in the entire world that works for that company is doing the same thing. And all of that is getting wrapped up into the total company's forecast for sales. Okay? The thought of that just by itself gives me a headache. Okay? So, oh my gosh, yes. They look at all sorts of stuff. Okay? Other questions? Other questions? Okay, going once? Twice? Okay, so that wraps up the income statement. What we'll talk about on Tuesday is the statement of cash flow. The statement of cash flow is one of my primary goals for you in this course, because most people don't really know a whole lot about the statement of cash flow. We talked about that a little bit more before, and we're going to go beyond what the book does with the statement of cash flow. So between now and Tuesday, in addition to doing your income statement homework, make sure you study the statement of cash flow in the book very carefully, and we're going to talk about that in more detail than the book goes into. Okay? So, all right, great class this morning. I will see you guys. Have a good weekend. Be safe, and I'll see you guys on Tuesday.